Okay, Mark Matthews is with us of Bank Julius Baer and Company. Mark, good to have you with us here. Thank you very much for your time. Mark, how's the global setup looking? I mean, directionally, are we in the phase? Because we've been broadly in two phases. One, the market quickly pricing out rate hikes and pricing in rate cuts, and then quickly pricing back rate hikes in and pricing out rate cuts. So it's either of the two. And, they last for a few weeks and we flip to the other. So which one is it now, according to you?
It's both. I was interested in Bank of America's fund manager survey that you may know they do every month, and they ask a variety of questions, one of which is, which do you think is the biggest risk for markets? And the biggest risk is split equally between recession and inflation, which tells you that the market can't make up its mind. So it vacillates between worrying about inflation, worrying about recession. And the data sort of suggests that too. I mean, I think last night we had, was it very strong housing starts, but then another number was weak. I'm sorry, I don't recall which. So the fact is the S&P is up over 8% since the beginning of the year. So it is climbing a wall of worry. Because it did fall so much last year. I don't think it's too expensive. And I think, you asked me at the beginning, Prashant, about the global setup. If I may say, I think the most important thing that happened yesterday was the numbers that came out of China show their recovery is indeed happening and it's strong. And that's important because I think the market was uncertain about China. They never got lots of stimulus checks in the mail like people did in Western countries. And so when they came out of their COVID lockdowns, people didn't know, well, would they spend or not? And they are. So the GDP quite handsomely beat expectations, 4.5 versus 4, and the retail sales in March were up over 10%, much higher than expectations. So we increased our GDP forecast for China this year from 5.3 to 6%. And I noticed that the big investment banks also upgraded their GDP for China. So that provides a very nice tailwind to the world, particularly the world outside of the United States, places like Europe and Southeast Asia, which depend a lot on China.
Okay. Mark, hi, good morning. Is the stage set now for a big recovery in the second half of the year, especially in a market like India?
Not necessarily, but I'll tell you one dark horse is the earnings, because the consensus is expecting earnings to be slightly negative for the full year and down 6% in the first quarter in the United States. And admittedly, only 34 companies have reported their first quarter results so far, but 27 of those have beat expectations, and it's the highest beat rate since 2012. So I think one good thing, ironically, maybe it's not ironic, but intuitively, is that the market, the consensus expectations are already very bearish, already pricing in a lot of bad news. And so if the bad news doesn't happen, then, that should set us up for, I don't think a big, bull market, but I think we can continue to climb a wall of worry, which is exactly what markets tend to do over the years that follow the end of a bear market. And we do think that last year's bear market ended in October. And if you just look back at the previous recoveries from bear markets, they climb that wall of worry because there is a lot of worry coming out of a bear market. You're still very skeptical. And so, yeah, I think we will continue to grind higher through the course of the year.
Oh, that's good news. Hi, Mark. Good morning. But what's the preference now? You'd mentioned as well that, as we know, a weaker dollar is good for emerging markets, and India as well stands to benefit out there. So from the emerging market basket, what's the pecking order? And also, if you could tell us, do you have a look at some of these IT earnings here in India? You've been a bull on the banking names in India, but any view on the IT names as well?
Sorry, Nigel, I haven't had a chance. I was actually on holiday last week, truth be told. So
oh, that's good news. You missed, we had quite a few disappointing IT numbers here in India, so I wanted a view on that. But let's take the first part then, the pecking order from emerging markets.
Yeah, I mean, I think this year China is a good market. There's a wall of skepticism toward it. The data that came out yesterday show the recovery is for real. And by the way, it just started. They only opened 3 months ago. The first month they reopened, everybody practically got sick in the country. They all got COVID. And so they weren't out doing anything, during January. And so really it's only 2 months, I think you could call it a real reopening. There's a lot more to go. So China is an inexpensive market. I believe it'll be a good market this year, probably will continue to outperform India this year. So that's just up until the end of this year. But longer term, India is our structural bet in the emerging markets. And all the usual reasons that I won't bore you with in detail, but, the demographics, the structural reforms, the move up the value-added ladder, all of those good things. And actually having not really done anything for 18 months, the valuation in India isn't expensive either. It's come down to its average versus emerging markets.
There was an excellent op-ed by Akash Prakash, who runs Amansa Capital, a large fund out of Singapore, explaining some of these points. And he conducted his own kind of, not survey, but amongst what he calls thought leaders in the investment world. And the common thread is they're all very bullish in India. I mean, near-term valuations are still the big problem. They're still very expensive as compared to other emerging markets, but no doubt about the potential here. By the way, if you've been following the news, Tim Cook has been to India to open the first Apple store here in the country. And of course, I mean, the store is the store, but the bigger talking point has been manufacturing, right? Moving manufacturing here in India, to India. Any thoughts, Mark?
Yes, I mean, it makes absolute sense. China, because the per capita income has gone up so much, is no longer a cheap place to manufacture. Still has a lot of infrastructure advantages, the supply chain, the fantastic ports and generally transportation. But yes, it makes sense to make things in India, particularly for a company like Apple, and it's been pledging to do that, particularly over the last 12 months. And sadly, this deterioration in relations between the U.S. and China, I don't think any American company looks very good making a lot of things in China. It's just sad but true, given the perilous state of the relations between those two countries. And doesn't look good in the eyes of voters. And so that shift is for real, and it's beneficial to India.
Oh, absolutely. And apart from becoming a manufacturing hub now, the Apple ecosystem actually generated 1 lakh direct jobs in India in the last 2 years as well. So lots is happening now in India. It's become a manufacturing hub, a services hub, and of course the job market has picked up as well. But Mark, pleasure speaking with you. Thanks a lot for joining in and speaking to CNBC TV18. Appreciate your thoughts this morning. That's the word coming in on the markets. That's Julius Baer, Bank Julius Baer, saying that India continues to be a good structural bet, and they're focusing on the recovery in earnings. They also like the Chinese market. The GDP data there surprised them positively. Let's slip into a quick break. On the other side of the break, our entire team will be joining in. They'll help us with all the data points for the day, all the big stocks that you need to watch out for as we kickstart a brand new day of trade. Stay with us.